Hi everyone, this is Arpita Gupta, founder director niveshmitra.com, a wealth tech company. And today I wanted to talk about something really interesting. What if I started investing in the top performing mutual funds? So if a mutual fund was the top performer, gave the highest returns in this year, next year I will invest in that. So we did this some study, we did a lot of data crunching, and here are the results. We did a study of the last 10 years, and what was the most interesting thing was that the top three funds did not stay stagnant, or there was very less commonality. So, for example, in 2011, it was Axis Long Term Equity, SBI Focused Equity, and Canada Robeco Blue Chip Equity. The next year, again, the three funds changed. 2013, again, the three funds changed. And what was the most interesting was high performing fund had many years of low ranking in the future. So, for example, if you see the fourth fund, IDFC Tax Advantage Fund, I was doing this study, for example, in 2014 Jan, and I just saw the results published in 2013, which fund had performed the best. I saw IDFC Tax Advantage was the top three fund. So I invested in 2014 some money into IDFC Tax Advantage. Just the year in which I invested, 2014, in the same year, in the first year of my investing, just following the year in which it was the top performer, it actually turned out to be the bottom performer. The huge underperformance was actually shown by this fund. So, pay special attention to the funds marked in red. Red cells represent the instances when the funds in the previous year was ranked 1, 2, or 3. That is, it was top performing fund. Whereas in the next year, it was actually ranked in the bottom half of the performance table. So what this depicts is, 1 year of outperformance or 1 year of top performance actually does not guarantee that the next years will be good enough also or not. It can actually, and there's a very high probability, you can see the table is filled with orange and red cells. There's a very high probability that the fund would have actually underperformed in the future years, and hence these years of low returns would actually end up pulling down the overall portfolio return, because I would actually end up investing in funds which underperformed as opposed to my expectation of being in the top three funds. So what do I do instead? How do I actually take an investment decision in mutual funds? How do I build a mutual fund portfolio? Number one, you need to realize the realities of investing. Remember, the world's best investors also recognize that they're also likely to make mistakes in their investment strategies. So, this constant urge of generating the highest possible returns can actually lead to the opposite. Try to focus not just on generating the highest possible returns in the market. In fact, performance is just one variable to your investment strategy. When you're doing a fund selection, there are much more variables. When you're designing an investment portfolio for yourself, performance or returns is just one variable. The other variables are how has the fund performed in the past years, in past bear markets, over multiple bear markets, multiple bull markets. What is the kind of volatility the fund faces? What is the investment strategy that the fund manager follows? So that, even if in a short term the fund underperforms for a year or two, you can actually, because you have confidence in the investment strategy of the portfolio manager, you can stay invested and give him a couple of years to actually show outperformance. How consistent the fund has been regarding the benchmark, regarding category performance. Number three, asset allocation and tapping opportunities. Ideally, how you can actually generate a little alpha for your investment portfolio is you can actually try to tap opportunities which are currently there existing in the market. Understand where is the opportunity instead of just selecting the highest rated fund or the best performing fund, or will this fund give me the highest possible return, or will it be the top performing fund. Instead of this urge, try to understand what are the opportunities, where is their undervaluation. So, for example, in 2020, we made our clients invest into small cap funds, small cap mutual funds versus large caps. So, small caps in the same time gave a return of 60% versus large caps gave a return of 30%, or blue chip or Nifty 50. All of this gave a return of 30% during the COVID, the first year, 2020, 2021. So, actually understanding where is the opportunity existing, if you actually try to do that, it can actually create a huge alpha to your portfolio. For example, in pre-election years, you can actually allocate some portion of your portfolio to consumption theme, or currently the capex cycle is going on in the country, private capex, public capex. So investing around those strategies. And number four, the most important, chase your financial goals rather than chasing the highest possible returns. So financial goals can be, after 40, I want to generate a passive source of income which can completely take care of my monthly living expenses. So I don't have to depend on my job or on my business or my profession to actually take out my monthly living expenses through that, and it can actually help me in wealth creation or financial goals, like I want to save for my child's Ivy League education, or just wealth generation. But again, it should be focused not more about how can I create the highest return, but your portfolio or your investment strategy should actually generate a more stable, a less volatile, and good performing returns rather than best performing returns. So try to chase your financial goals rather than chasing the highest possible returns or being the top three. If we can help you invest, please reach us on our WhatsApp number or email ID, and one of us will get in touch with you. Thank you so much.